The S&P 500 achieves bull market status, and the narrow rally is showing signs of broadening out beyond megacap tech. But the big question for many investors, when is the melt up going to melt down? Let's bring in our guest host, John Authers, who is the Bloomberg opinion columnist and previously spent decades at the Financial Times. He's known by many as the writer of the Lex column. Great to have you here with us this morning, John. So help us address that big question first. In the melt up that we have seen, does it show any signs of wavering early on right now?
It doesn't yet. I would like to say, however, that if anything gives me a toothache, it's the notion that any rise of 20% from a low equals a bull market. There's a lot more to whether this is truly a bull market than whether it happens to have passed that number. And I think, broadly speaking, yes, you're right about the narrowness. It's not unusual for rallies to be narrow, to be quite as thoroughly dominated by large companies as they are at present is strange. And it does lead you to question whether the 20% gain is permanent, whether it can be built on.
And so, John, it's Julie here. Thanks so much for joining us. It's a pleasure to have you here. So if it's, and I know there are lots of different ways to define a new bull market, right? So what do you look for? What are the markers you look for, if not just that simple 20% gain from the low? And what would convince you that it could be more sustainable?
If we had already had a recession, I would feel more comfortable about it. There's an extreme shortage of bull markets that started before the recession had even happened. They are not the same as the economic cycle, but they're linked to it. Similarly, there are, as far as I can remember, I don't think there are any recognized bull markets in history that started while the Fed was still hiking. Generally, you wait until they've started cutting. It would be strange if this was a rally that could persist despite that. The other thing that bothers me is the valuation. Generally, if you're talking about one of history's really big secular bull markets, like the one that started in 81, 82 after Paul Volcker had slayed inflation, or indeed if you're talking after the one that started after Lehman in 09, stocks tend to be really, really cheap. And really on any basis you care to mention, they're not. They weren't in October when the 20% rally started, and they certainly aren't now. So those are all reasons why I'm nervous to call this a bull market. If we avoid a recession altogether, then which some people think is a possibility, then maybe you can put down all that happened last year to this, to a very strange, very dramatic correction from an overvalued level. You could therefore say actually that it's perhaps more like the Black Monday crash of 1987. Took a little longer to unravel, but it was one of those rare occasions when you have a very sudden, very aggressive correction that's really a market event, not an economic event. I guess we might yet find out in the future that was true. In terms of avoiding a recession, if we do, and certainly the recession has taken a lot longer to arrive than many expected, then yes, I would think you probably can sustain further rises from here. You probably would, if we really can avoid any kind of a significant downturn, think that this could be a sustainable rally. Getting back to what we were saying earlier about Trump, incidentally, just note that if that's really true, if the stock market is right, then whether he's indicted or not isn't going to make much difference. If we've really still got a stock market rallying by the end of next year, and inflation has come down immediately to 2% by that point, and there isn't terrible unemployment, I don't think the Republicans are going to be winning that election. Whether you find that believable or not is another question.
So, John, then in terms of signals, because as we look at this narrow stock market rally and you pair that with what the VIX is doing, and then on the other hand, you look at the bond market, what is giving us the clearest indicator of where the market's headed next?
I wish, I wish I knew. I think if you look at the bond market, it's generally dangerous at any time to ignore what bonds are telling you. And bonds plainly are showing some degree of concern that more tightening is going to be necessary, that there is, we have more of a problem with inflation to deal with. That in many ways is good news. It does show that that there are reasons to hold stocks rather than bonds. It does suggest that there is a certain dynamism in the economy, but obviously, all other things equal, higher yields make it harder to justify higher profits, higher PEs, higher share prices. I think if there is one issue that really makes me wonder whether this is a sustainable bull, it would be earnings, corporate earnings, which have not declined anything like as much as had been expected, and earnings expectations have turned up quite significantly over the last month or two. You're not seeing margins come back down in the way that people were expecting. If it's really the case that that corporate earnings can continue to do better than people had thought, possibly due to finally managing to improve productivity thanks to AI or whatever, that would make a difference. You do, however, have to put up with the issue again. It begins to become almost a catch-22. Part of managing to maintain your margins, part of keeping earnings high, is marking up, is able to have pricing power, if you want to use the very loaded phrase that's popular these days, it's greedflation.
Right.
Therefore, it's difficult to see how you really do keep an earnings boom going without seeing rates rise higher.